the late 2019 episode, that was just before COVID. And the repo rates spiked to 10%, and that the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved.
Financial analyst and precious metals expert Bill Holter is sounding the alarm on what he calls one of the most dangerous financial imbalances in modern history: the complete disconnect between paper precious metals markets and physical reality. For decades, global markets have allowed traders and institutions to create massive amounts of paper gold and paper silver through futures contracts and derivatives. These synthetic instruments have suppressed real prices and created the illusion of abundance. Holter argues that this system has reached its breaking point, and the coming reckoning could redefine global wealth and monetary trust. According to Holter, the paper market functions like a pyramid scheme, sustained by confidence and liquidity rather than tangible backing. Each paper contract represents a promise to deliver metal that, in many cases, simply doesn't exist. As long as participants trust the system and avoid demanding physical delivery, the illusion continues. But confidence is fading fast. Central banks, industrial users, and private investors are increasingly opting for physical possession, removing gold and silver from the supply chain and tightening availability. Holter believes that once a critical mass of investors demands physical settlement, the entire leverage-based structure will unravel. This unraveling, he warns, will lead to a violent repricing of precious metals. When the market realizes that only a fraction of contracts can actually be honored with real gold or silver, prices will be forced upward to reflect true scarcity. Silver, in particular, could see explosive gains due to its dual role as both a monetary and industrial metal. In Holter's words, when people lose faith in paper promises, they will pay any price for something real. He sees this as not just a market correction, but a systemic reset in how value is perceived and stored globally. Holter also criticizes the broader financial system for fostering this instability through endless debt creation and central bank manipulation. Artificially low interest rates, quantitative easing, and unbacked currency expansion have distorted every major market, from bonds to real estate to commodities. This has created a fragile global economy dependent on cheap money and speculation rather than productivity and tangible assets. Holter believes that when the monetary tide finally turns, fiat currencies will lose credibility rapidly, and investors will rush to hard assets like gold and silver as safe havens. Ultimately, Holter's message is both a warning and an opportunity. He urges investors to act before the system resets, not after. You can't buy insurance after the fire starts, he cautions, emphasizing that real wealth protection depends on owning physical precious metals, not paper claims. As faith in financial institutions and fiat currencies erodes, Holter believes the world will return to the timeless truth that real value lies in what you can hold, not what you're promised. Now, we present the clips from Bill Holter interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
The paper markets were the tail on the dog, but the tail constantly wagged the dog because they would overwhelm the physical markets with paper. The problem now is they've done it for so long and to such a grand extent that now there's a question whether these paper contracts are going to be able to deliver. And the answer, I think you're going to find in the next month to 3 months, we're going to find out that no, the paper markets are not a substitute for real physical because they have to deliver real physical that does not exist to be delivered. The bottom line is all of the futures, options, paper products, etc., they're all based off of the physical metal in the first place anyway. That's why they're called derivatives. They're derivatives of the actual product. If gold doesn't deliver, the system dies anyway. But if gold doesn't deliver, it's not a direct effect on production, if you will. Silver is used in so many different applications, whether it be industrial, technological, medicinal. I just did an interview and was talking about every time they shoot a Tomahawk missile, there goes a monster box. You can't make a Tomahawk missile without roughly 500 ounces of silver. So silver will have profound ramifications to the real world, to the real economy. Now, that said, if silver goes failure to deliver or gold goes failure to deliver, you're stuck in the casino because the casino will close. And when the casino closes, and we've talked about this, for the last, year and a half, maybe even 2 years, we've talked about the great taking. Once the casino closes and banks and brokers and insurance companies start going belly up, they're going to take your capital with them. And that's why it's so important to get your capital out of the system into something, gold and silver, that cannot bankrupt, and in a place where it can't be taken from you. Going back to visit the late 2019 episode, that was just before COVID. And the repo rates spiked to 10%, and that the Fed was having to put $100+ billion into that market every single night so it could clear. Then conveniently along came COVID, and two things happened. The real economy worldwide was definitely stunted or shut down, whatever you want to call it. There was less demand for credit because of COVID, and it allowed central banks all over the world to flood the markets with liquidity. Problem solved. Not solved, but the can was kicked down the road. Here we are again. We're nowhere near where we were in October of 2019, but the overnight rates are starting to move higher again. It's a concern and should be watched. Again, everything, whether it be the real economy, production, consumption, transit, and also the financial world, the financial economy, everything runs on credit. If credit gets disrupted or credit ceases anywhere, it'll shut the whole system down. We have interest rates still at basically generational lows. I mean, we're not where we were 3 or 4 years ago. We're not at 0% rates, but rates are extremely low. There's no risk premium in interest rates at all. So brokers and banks, they understand that the likelihood long-term, 5 years, 10 years, longer than that, the likelihood is that rates are going to go higher, not lower. And they also understand that there's going to have to be another mass printing, whether they call it QE or not, it doesn't matter. But there's going to be another global mass printing. And the problem with that is that debases the currencies, and that lowers the value of the unbacked currencies. If the values are lower, then you got to give more of dollars or euros or yen or whatever for that same ounce of gold or the same ounce of silver. So I think they're looking at it pragmatically and saying, yeah, the day of buying and holding bonds is over, and that's why they're recommending half of that bond position be liquidated and put into gold. The only problem with that is if everybody did that, you'd have gold at probably, who knows, $2 million an ounce. Just, pick a number, but it's going to be super, super high. If you're looking to sell junk silver, you're looking at $3.50, $4 under spot. And if you're looking to buy junk silver, you can buy it at spot, maybe 50 cents over spot. It's the cheapest form that you can buy right now. So if you're buying silver, you definitely want to buy junk silver. It's the cheapest and it's the best. And if you're worried because the bid is below spot, and it's well below spot, pretty much everything else is very close to spot, or even eagles are above spot, understand what has happened. We finally got back to this $50 level, and we stayed here. We've been here for, call it a month, but we're approaching it, and literally, I'm not going to say the only form or the only way to buy silver in the late 1970s, early 1980s was junk, but that was by far and away the primary form of silver to buy. So what you've seen over the last few months is that many of these people who have held on for 40 plus years have turned seller. And the dealers and the wholesalers got overwhelmed with the selling. So what did they do? They lowered the price. And if they're, call it $4 under spot, that's 8% below spot. And what they're doing is they're sending those coins into refiners to melt them down. And they pick up that 8% is what they're doing. That said, this is a short-term event because the supply is already, the supply of junk being sold is already starting to dry up. And when it does dry up and prices start to normalize, guess what? There's way less junk available that still exists because it's been melted down. And I'm gonna say right here that I think when all is said and done, junk silver is going to become the most expensive form of silver in the United States, even priced higher than Eagles. And I say this because I believe the supply is being destroyed on a daily basis. It's being melted down.
Financial analyst Bill Holter warns that the global precious metals market is nearing a breaking point due to a massive disconnect between paper assets and physical supply. For decades, traders have created paper gold and paper silver through derivatives and futures, artificially suppressing prices and creating an illusion of abundance. Holter argues this paper-based system resembles a pyramid scheme, sustained only by confidence. As investors, central banks, and industrial users increasingly demand physical metals, confidence in paper markets is rapidly eroding. Once too many investors seek real delivery, Holter predicts the system will collapse, triggering a violent repricing of gold and silver to reflect true scarcity. Silver, he believes, could see explosive gains because of its critical industrial demand and limited supply. Holter also blames central banks and government policies, like endless debt creation, money printing, and near-zero interest rates, for destabilizing the economy and inflating bubbles across all markets. When the fiat system finally loses credibility, investors will flee to hard assets such as gold and silver for protection. His message is clear: prepare now, not later. Real wealth, he insists, lies in what you can hold, not in paper promises.